Joining us now to talk about the markets from Cal Bay Investments is financial advisor and chief market strategist Clark Geranen. Well, Clark, the market has continued to climb despite concerns around inflation, interest rates, and geopolitical tensions. What do you think investors are getting right about the current environment, and what risks may still be underappreciated right now?
I think one of the main things that investors have gotten right is just staying calm through all of the volatility. This year, we've had the conflict in Iran and oil prices skyrocketing, so it's been tumultuous. But I think if we look back over the past 6 years, we've really had to jump over a lot of hurdles. 2020, we had the pandemic. 2022, we had the bear market. 23, we went through a banking crisis. And last year, we had to deal with tariffs. And so I think through all of this, it's been these tests that investors have been able to withstand. And really, it's kind of made them harder and number to a lot of the market volatility. So I think that's one of the number one things that we've seen investors do right. Second is going to be paying attention to the earnings as opposed to the headlines. I think a lot of people get their emotions riled up depending on what news station they watch, and you could say the same for both aisles politically, that it gets them anxious and more worried about their accounts. I even spoke to somebody yesterday who typically doesn't like to look at their accounts, and they said, I don't even want to ask, but how am I doing this year? And I think if investors are paying attention to more of the data-driven numbers, such as earnings, we have earnings that were year over year above 28%. And so when people ask, how is the market doing? We're really able to point back to a lot of the solid data that supports that. So the more investors try to take themselves maybe out of the headlines and focus more on how companies are doing, then I think the better off they're going to be. Another thing is really focusing on the AI cycle. And I think a lot of people have been able to get on board. It was obviously kind of a slow ride at first. People are speculative. I think it harkens back to 2000 and the dot-com boom. So I think people are concerned in general or hesitant. And so those are a lot of the three things that have done really well and investors have done really well over the past few years. I think to the same token, if we're looking at what we should be potentially worried about or risks on the table, you could say the same thing. I think AI could be one of those risks. We've had so much capital expenditure going towards AI, and we've just been fueling the beast over the years, and it has worked out. So everything's panned out so far, but that doesn't mean that every company is going to have the same results. So I think that's one of the risks that we'll look for. Second risk is going to be the Mag 7 concentration. We see some of these behemoths just surging the S&P and the markets forward. Of the Mag 7, it made up about over half of the return in 2025. So clearly that is some concentration risk. Everybody wants to be exposed somewhat, but if that's the only thing you're in, then you really need to be aware of how much risk you're actually taking, especially as we're coming through these new cycles within the AI boom.
As you just outlined, Clark, investors have navigated a wide range of surprises over the past several years, from inflation shocks to banking stress and geopolitical conflicts. What lessons should investors take from this period, and how can they build more resilient portfolios going forward?
So like I said, I really do think it's trying to take your mind out of the headlines and just focus on what the markets are actually doing. And so part of that was going through the pain of some of these hurdles and the down draws and pullbacks that we saw. And so I think a lot of that is also just building in some stop gaps within a portfolio, whether that be putting stop losses on certain stock positions. Say you have a concentrated position. Maybe it's time to write some calls on those positions, or it's introducing some new non-correlated assets. And so that can be a mixture of alternatives or say commodities or infrastructure linked securities. And so it's putting something in those portfolios that might act as a hedge moving forward. Like we saw in 2022, That was one of the biggest lessons that I think that the whole financial world learned, both advisors and investors. And that was when we saw both equities and bonds go down double digits for the first time in history. And so a typical 60-40 portfolio didn't hold up and didn't have the hedge that everybody hoped it would. And so I think that was a big lesson for people, was seeing that bonds aren't always the safe call and they're not always the hedge against equities. And so I think we've seen a lot more money move over towards that side of the arena to help bolster an account.
International equities have shown signs of renewed strength in recent years, Clark. How are you thinking about the opportunities and risks outside the US? And does international diversification deserve a larger role in portfolios today?
So typically, international has been a position, at least for us, that was around 10%, maybe less. And I would say over the past few years, that has been a lesson. About 2 years ago, we started increasing that to about 15 to 20%. And I think that's still a little bit underweight than most or a typical advisor would say, um, which is fine. And we have been okay with that. The valuation on international still remains low, which for us, still a great opportunity point to jump in. But I think it has been an adjustment for investors. I think normally they're used to having a lower amount. And when they start to see international or emerging markets take off, there is some FOMO that comes with that. And so that's why we've seen, I think, even more dollars just continue to cycle over. Not to say there's also been a lot of international turmoil with the current administration. I think it does make the landscape a little more volatile. But in general, I think keeping a strong international and some exposure to it, emerging markets, is healthy for a portfolio and can be part of hedging the overall portfolio.
Finally, Clark, as we look ahead to the next 12 months, where do you see the most attractive opportunities across asset classes? And how should investors think about balancing growth potential with risk management in today's market environment?
So one thing we really like right now is a barbell methodology. And that can be looked at in a few different ways. Some people view it as having money market and some high risk assets, but it's really just the idea of having a low risk asset and a high risk asset. So sometimes that's money market and some AI stocks, or sometimes that's CDs and AI stocks, or fully large cap growth and bonds. And so we've really liked that strategy recently just because the short-term interest rates have been so high. And so it gives you the ability to get lucky. It also gives you the ability to strike when the iron's hot. For instance, last year when we saw tariffs being implemented, that was a great time to put cash to work. And that's really been the story over the past 5, 6 years, is when we see any pullbacks of significance, putting cash to work, you're almost making your money up within 3 to 6 months. And so we still like that and view that as an opportunity when we do see any pullbacks. The other thing we've been looking at is more selective stock picking. And I think that should be just because we've seen the concentration in the Mag 7, like I spoke about. But the problem is as we see dollars come out of the Mag 7, there has been a lot more breadth across the S&P 500. And so we do like looking towards individual sectors and selecting individual stocks. In addition to that, we also love the mid cap and small cap space. That's an area where we find that there's great opportunity, and it's proven to be right so far this year. The past few years, small caps didn't necessarily play out like everybody thought. I think everybody thought rate cuts were coming, and that was just going to be this tailwind for small caps. And that actually wasn't the case. And believe it or not, we've actually seen this year a story could be made against small caps because we've had rate cuts knocked off the table, inflation has been rising, and now there's even the potential for a rate hike. But meanwhile, the small cap has doubled what the S&P 500 has done. So we still like that. moving through the rest of this year and into next year, because when we do eventually get some rate cuts, maybe in 2027, that's going to be even more of a tailwind for those small cap stocks.
Well, Clark, really great to have you with us. And thank you to everyone out there watching. Once again, that was Clark Geranen, Chief Market Strategist at CalBay Investments. And I'm your host, Jenna Dagenhart with Asset TV.